What is going on? What is going on? Today's video is going to be a request from one of the comments left below. Totally forgot to leave it in the video. I tried looking for it, but because there's just so many comments that I have to sift through, I do apologize. I believe you should know who you are. I think you were one of the only comments that requested this video. But before I get started, welcome to my channel. I am the Covered Call Guy, and for those who are new, my goal here is to create $120,000 in annual passive income. Currently have 7 holdings with GPIX, QDivO, GPIQ, IWMI, SPYI, QQQI, and iDivO. With these current 7 holdings and more to come, it currently yields me about 70 grand a year. That means about 5.8k a month, 1.3k a week, $193 per day. I keep messing that up. $8.05 per hour. Okay. Before we get started, legal disclaimer. Okay, the information presented in this video is for information and entertainment purpose only and should not be construed as financial, legal, tax, or investment advice. I am not a licensed financial advisor, accountant, or attorney, and no professional relationship is being established through my content. Okay, all opinions expressed are strictly my own and do not constitute recommendation to purchase, sell, or hold any securities or financial products. Please, you are the viewer, so you are strongly encouraged to perform your own due diligence and consult a qualified professional before making any financial or investment decisions. If you don't, you are a dummy. All right, with that out the way, let's get started. Today's video is going to be on the new JPMorgan, okay? ROCY and ROCQ. Let's look at it under the microscope and see if it should belong in your portfolio, okay? We're going to be putting it up against the 2 other titans, the 2 other gold standards, in my opinion, is Neos and Goldman. So I'm breaking down whether these flashy new ETFs or income machines or just smoke and mirrors. All right, so let's look at the setup, right? So these 2 offer a 0.35% expense ratio. They are declaring in pretty much a fee war because I love low expense ratio. This already caught my eye, okay? So JPMorgan recently just launched ROCY and ROCQ with a ruthless low 0.35% expense ratio to absolutely crush competition. Okay, why do I say to crush competition? Because guys, on this channel, at least on this channel, I don't know how you are with your investment thesis. At least on this channel, we are holding for a minimum 30-year time frame. That is what I plan for when I buy anything. Really, I plan to hold for a minimum of 30 years. Okay, of course things can change, but the basis that I buy things for the long run. So with 0.35 versus 0.68, 0.97, right? It matters. Okay, so look, for reading from their perspective and and at least what they're trying to do for their shareholders is that they are trying to promise you tax deferred income while miraculously preserving some upside using a cost spread overlay. But before we do get to their their so-called brilliant tax loophole, I'm gonna expose some ugly truth. They aren't advertising, okay? But let me just say again, I do love some low expense ratio. Okay, let's look at the yield illusion, okay? Like all things, all great cover calls, all great things, all great income ETFs, okay? A double-digit yield is completely worthless if your principal is bleeding out to fund it, okay? Understand that, especially for those who just found my channel, for those who are new, understand this, okay? These ETFs convert market volatility into income. These are not dividends. They are not organic. They are manufactured, okay? Hence why you pay such a higher expense ratio for the active management. Simply put, if the fund distributes 10% while the underlying portfolio only grows 5%, right? The total return is only 5%, but distributing 10% on an annual basis. As this is as simple as I can say it. It's effectively paying you your own money back, your own principal back, plus you lose out on the expense ratio plus the taxes. Okay, so if this happens for over the course of 5 consecutive years, this will completely destroy your compounding base and or you lose everything. It goes to zero. Okay, the active management myth, okay? 41% ROCY top 10 weight versus 54% ROCQ top 10 weight. And what do I mean by that? Don't ever be fooled by, don't let the active management label fool you, okay? These funds are dangerously top heavy, okay? ROCY claims to be a safe core fund, or at least that's how they're presenting themselves, yet heavily relies on massive tech stock like Nvidia, Apple, and Microsoft. Okay, now it just depends how you look at it. Of course, Mag 7, in my opinion, is always going to be the Mag 7. Whatever is in the Mag 7 typically is always going to be, you know, quote unquote, the safer bet. Okay, ROCQ packs a 54% of his entire portfolio into just a few mega cap tech giants. Okay, hence the Mag 10. So if tech stock gets crushed by rising interest rates, or right, these funds are going straight to ICU. Okay, now not particularly, maybe not JPMorgan, and I'll explain why. All right, crash and complacency. So if the Nasdaq crashes, say 30%, say somebody decides to escalate, you know, decides to really escalate in the regional war, something happening, right? Oil goes to 200, 250, right? You do carry almost the entire downside risk, right? The tiny option premiums here won't save you, okay? But a slow volatility melt up is actually even worse. That's something us covered call ETF investors don't want, okay? If the market grinds higher without fear, that means option premiums collapse and your yield dries up instantly. All right, that's the worst part of this. All right, and then on top of that, this is the trade-off here. Meanwhile, your upside gets hard capped by short calls, so you lose on both ends. Okay, this is the ugly part. All right, let's look at the hidden frictions. Okay, so this is a new fund scaling launched in March 2026. Is literally 5 seconds old. These funds already hold over $100 million in assets each. Why? Because it is JPMorgan. Okay, this is where, yes, it is a new fund, but on top of that, we do have to look, okay, who's releasing it? Well, it's JPMorgan. It is the Titans of Titan. There is no one bigger than them. You look at JPMorgan essentially as a mini Federal Reserve. That's how you look at them. So, you know, that is actually quite good for a new launch, okay? Making it potentially good time to get in while they're scaling up, okay? So as they're $100 million, as the asset under management starts to pile up, right, you might be consider yourself the early investors. Okay, look, there is still the invisible cost, right? 0.35% fee is cheap, but it still completely ignores the massive upside you do sacrifice and heavy transaction costs of constantly rolling options every single month. Now, given it is a huge fund, it is JPMorgan, and it is the Titan of Titans, this might not affect them so much. They might get better bid-ask spreads because there's already a huge asset under management, and of course it is JPMorgan, and everybody wants to do business with JPMorgan. Let's enter the gray area. Okay, this is where you can either take it as good or bad. All right, now that I've covered the ugly, the bad, the disgusting part, all right, let's talk about the trade-offs. Right now, this is the trade-off area when I say the gray area, because you can understand where you can play it both sides. It can either be good or bad. Okay, now you have to look yourself in the mirror and accept that you are explicitly trading away long-term wealth for immediate cash flow today. All right, let's look at the total return trade-off. Okay, 65% average upside capture versus a 95% average downside capture. So historically, funds similar to ROCY only captures roughly 65% of the market's total upside, but they do absorb a much more brutal 95% of the market's downside. Okay, there is no hedge, there's nothing here. You do get some buffer, but historically, funds similar and that operates similarly to this does have these historical data. Okay, so while you are actively capping your compounding potential just to get paid every 30 days, okay, if you are young and trying to grow your net worth, then I would say, hey, look, if you don't need the money right now, don't touch these, right? You might have a little bit of this, but you might not be in my positions where these become a core. Okay, so if you're young and you want to compound and you don't need the income now, sure, don't touch these. But I always do encourage everyone to build an income source, but again, it just depends on whether you have already a great job or you're already in your financial, you know, you got daddy's money. Okay, all right, I got cut off, but it's essentially why JPM beats cover calls. Okay, so talking about traditional cover calls, right, put a concrete ceiling on your gain. So if the market rocket ups, you will miss it, right? But JPMorgan, at least I'm saying for these two, you just call spreads instead. Who else does this? Leave it in the comment section below. Pause the video, timestamp. Who else does these strategies, right? So that means they sell one option for cash, but immediately buy a protective option further out. So this uncaptured ceiling letting you re-engage and ride the wave if the market goes parabolic. Look like JPMorgan is starting to see, wait a second, one of these issuers out here is starting to eat away at my share of the pie, and I don't like that. All right, hunting the risk premium. Okay, so this is pretty much their strategy, like all cover calls, like for the most part, all cover call ETF or issuer does this. The precision strike, right? Amateur ETF will blindly sell options at 100% of the portfolio, completely strangling the organic growth. All right, so dynamic override. I do think right now JPM is actively targeting just about 30% to 60% override ratio. I think that's what I'm understanding from what their perspective and strategy is, leaving a more massive chunk of your stock free to grow. Sounds like they're competing with the two I just mentioned early in the video, right? Oh God, you let me know if you think you understand this correctly too. I could be wrong here, right? Volatility premium. So it looks like their strategy is that they wait for fear to spike, selling expensive options to panic traders to fund your monthly paycheck. Okay, the good tax alpha and the solutions they're giving, right? So this is where JPMorgan engineering does become a more absolute masterpiece. Okay, so if you need immediate cash flow, even if you're young, I'm going to show you exactly how these funds legally shield you from the IRS. Okay, let's look at the section 1256 cheat code. Okay, look like they're bringing everything that is working from other funds into their holding. So because they exclusively trade broad index options, well, then they triggered the IRS section 1256 for, right? That means they've given them a 60% options gains on ultra low long-term capital gains rate. So if you're a high earner, right, this slashes your blended tax rate to about 6 to 8%. Okay, so you retain a much higher portion of the gross yield compared to ordinary income strategies of their JEPI and JEPQ. Okay, the ROC superpower. Okay, so how do they do this on top of the 60/40? Of course, tax deferred, right? So JPM is actively harvesting losses, so your monthly cash is classified as ROC, right? The IRS doesn't tax you immediately. You just defer taxes for years until you sell. The golden rule. Again, I would say at least never put these in tax shelters IRA because you completely waste this superpower, right, of the tax loophole. Right, these belong directly in your standard taxable brokerage account. And of course, if you need the income now, why would you put it in an IRA? It just makes no sense. At least to me, it doesn't make any sense. You can prove me wrong. All right, where does the cash come from, right? And this is what I think. Still very new fund. It's my guess. I'm gonna say at least option premiums is gonna be 60%. The ROC balancing is about 25%, and underlying dividends is about 15%, right? So distribution are highly optimistic, right? Not fixed. I mean that by while corporate dividends provide a baseline, the overwhelming majority of your payout is driven by harvesting that volatility risk premium, RVP, okay, distributed primarily as tax deferred ROC. Again, this is just my guess. I could be very wrong with these numbers. Option premiums could be like 99%. Who knows, right? Again, these are very new. You do when even when it comes to JPMorgan, when these are new funds like this, you should be much more cautious. It's always good to be cautious, right? That way you give yourself that buffer. Okay, that's the way I like to invest. All right, ROCY, look, I think of this as the safe bond proxy, right? So for those who are the older Gen X boomer, right, perhaps you like ROCY a little bit more because, you know, you might want to put some into ROCY because of the safe bond proxy. That's how I see it. I'm assuming they're going to have a 79% base market yield. I think that's what they're assuming to mirror JEPI and JEPQ. And then when the fear is high, of course, they can push it up to 11.5% with high fear yield. So the way ROCY is, I think ROCY should act as your stable lower beta anchor to replace your boring fixed income, right? In a completely dead market, you still get a pretty respectable 5.5 to 7%. Very, very good, okay? Don't let anybody tell you that's not good. That is very, very good. So in our normal baseline market, expect a smooth 7 to 9% is my guess. If geopolitical fear strikes, then ROCY payout could surge up to an incredible 11.5 or 12% as the JPQ. All right, ROCQ is the maximum tech yield. That's how I should see it. That's how you should see it. It pretty much just mirrors JP and JPQ, right? So I'm assuming it's going to give a 9 to 12% base market yield with over 15% if high fair yield happens. So if you want maximum yield for this part, right, ROCQ monetize the extreme volatility of NASDAQ MAG 7, right, or MAG 10. Right? So even in the absolute worst case scenario, it should pay a little bit more aggressive 7.5 to 9.5, right? So in the normal market, you should pull 9.5% to about roughly 12, mirroring JPQ, right? So if the tech experience a violent shock, then option premiums obviously will blast your yield past 15%. Okay, so JPM's obsolete the old guard. Okay, and what I mean by that, this is, of course, I do mean this in a hyperbole way, right? I'm obviously kind of talking out of my rear end here, right? So looking at this, right, their own JEPI and JEPQ is ordinary income. So why would you even choose that over ROCY and ROCQ? Looking at the NEOs, right? Well, it's kind of doing everything it does with lower expense ratio, and right now you can even mirror, you can still hold NEOs and ROCY and ROCQ because now it is you're betting on two different active managers on two different play styles. Okay, so JPMorgan does mathematically destroy the older generation of cover call funds, right? And they are trying to undercut NEO's fee by half while fixing the toxic ordinary income tax problem that plagued their old legacy funds of JEPI and JEPQ funds. Oh shit, what's happening here? I love it. I love the competition. I think they're starting to feel the heat. As you know, NEOS is constantly growing in assets under management, and JPMorgan is feeling the threat. Okay, let's look at the 730 blueprint. Okay, so my optimal strategy is a 70-30 split right inside my taxable brokerage. Now, this is, of course, if you only buy these two. Obviously, this slide is only for those who are a JPMorgan maxi, a JPMorgan fanboy, a JPQ fanboy. Obviously, if you only, like, some people are crazy NEOs, you know, fans, and will only split 50-50 with QQQI and SPYI. I've seen people like that. So of course I'm taking it here with, don't do 50-50, probably a 70-30, right? So if you're such a crazy fanatic, right, send your percent into ROCY. Not financial advice, of course, as your more stable anchor to preserve your sequence of return risks, right? And then use the remaining as ROCQ, right, as a more high-octane satellite to aggressively boost your overall yield. Okay, and of course, you wait for market dips when the RSI drops below 30 to initiate these positions, right? So then it mathematically locks in a higher yield on cost for you. Okay, so I got cut off, but the verdict here is cash flow meets market reality. And what do I mean by that, okay? ROCY and ROCQ, again, are not magic shields, right? They're just like pretty much any other cover call ETFs, but now they're understanding that the Goldman strategy works, the NEOS strategy works. They're looking at a little bit more of amplified, right? They're understanding that these issuers have started a trend, a strategy, and they're working, right? Right, again, they won't make bull market irrelevant, but and they also won't protect you from a tech-led meltdown. So if the S&P market rockets, right, I'm gonna split into these two. Okay, pros and cons. These funds will likely lag, but let's look at the pros here, right? If you are concerned about income and you need the income, well, this is the pro. Tax deferred income. Your monthly payout aren't immediately taxed, letting compounding work in your favor. Okay. Upside uncapped, sort of, right? They're using the Neos and kind of / Goldman strategy here, where call spreads let you participate in some market gains, right? Unlike the traditional cover calls. And then income on demand, again, perfect for investors who value a steady, optimistic cash flow over pure market growth. Okay, what are the cons though? Okay, market risk remains. Okay, just because it's from JPMorgan doesn't mean crap, doesn't mean nothing. Okay, a steep downturn still hits your portfolio the same way it hits any other holdings. Principal erosion risk. Okay, these are cover call ETFs, and if they don't handle and manage their distribution correctly, and if they don't, you know, constantly outpace the underlying returns, well, your compounding will take a hit and your principal will take a hit. Okay, not a growth substitute, right? These aren't meant for long-term all-in growth investors. They might be someone for like me, all-in long-term income investors. Okay, so my bottom line here, guys, if your priority is tax smart income with some participation in upside, right? JPMorgan pretty much built a cleverly engineered tools to rival Neos, Goldman, Amplified, and any other cover call ETFs. Okay, time your entry, of course, during the market dips. These are new. Still, it's great. It's you know, I mean, it is a solid asset under management, and it's from JPMorgan. I would say, look, if you're gonna get into it, just buy now. I mean, but for those who have, you know, money to wait on the sideline, sure, right? Enjoy the monthly cash flow, right? That's what the channel is all about. That's what my strategy is all about. If you found my channel, obviously, that's what you're all about. And let the pros handle the heavy options work, right? Just don't confuse these with pure growth engines, okay? They're not. All right, if you got anything out of this, and again, thank you for leaving a comment. I told you guys I read all comments. I try my best to reply. Yeah, leave in the comment section below and let me know what else you want to see, and I'll do my best. So shout out. I totally forgot to put you in the presentation here in my video. I do apologize for that, but you know who you are. I think you were the only one that left the comment, so I apologize for that. Thanks for watching, guys. If you got anything out of this, again, subscribe, comment, like, and leave me your thoughts. Support your channel. Thanks for watching. Stay tuned. Catch you guys on the next.